Hi, everyone, and welcome to Intermediate Accounting 2, Chapter 18, Step number 2, Deferred Taxes. So we did step number 1 in the last video, where you have to determine the taxable income and current tax expense for the year. In this video, we're going to determine the deferred tax asset liability and deferred tax expense for the year. And then in the next video for Chapter 18, we're going to go through the accounting for tax losses. So let me just remind you of what this looks like in the financial statements. So if we look at Canadian Tire's financial statements for 2019, we have for income statement, we have our revenue, we have our gross margin, we have our expenses, and then we have our net income before income tax. Okay, so all the other chapters, you've kind of learned everything up until this net income before income taxes. What we did in the previous video and what we're going to do in this video is look at how do we determine income tax in order to get your net income after tax. So if you look at note 16, income tax expense, it shows you your current tax expense, which we figured out in our previous video. We're going to tweak this a little bit in our next video for accounting losses. But right now, you know how to get to the current tax expense. And then this video will explain how to get to this deferred tax expense, which is also going to have a resulting deferred tax asset or deferred tax liability on your books as well. Okay. So just to recap for step number one, we start with accounting income. We're going to adjust for our permanent and temporary differences. And then we get permanent and temporary differences means differences between taxable income and accounting income. Then we're going to get taxable income, multiply that by our estimated current tax rate, and that's going to get us the current tax for the year. And then we're going to do our journal entry to record our current tax, which is debit current tax expense, credit income tax payable. Okay, so that was step number one in the previous video. In this video, we're going to figure out how do we record the deferred income tax. So there's two methods to record these deferred income taxes. There's a tax payable method, which is only allowed in ASPE, and it only calculates the current tax expense. So we don't actually have to do the deferred tax expense under the tax payable method. So under ASPE, you can choose to do the taxes payable method, which means we only calculate current tax expense. We don't have to calculate deferred tax expense. So for anybody that's going to be using ASPE taxes payable method, going through this video, we don't have to do it for under the tax payable method. You would just do that step number one, figuring out current tax expense, and then step number 3, accounting for tax losses. Then there's the asset and liability approach, which is required by IFRS, so you have to do it under IFRS, and it is an option under ASPE. So ASPE, you get to choose whether you want to do the taxes payable method or you want to do the asset and liability approach. So this approach calculates the current tax expense and the deferred tax expense. There's a little bit of a terminology difference between ASPE and IFRS for deferred taxes. So ASPE calls it future, so they call it future tax expense, and future tax asset, future tax liability. IFRS calls it deferred. So I'll call it deferred from now on, but just note that there is a little bit of a terminology difference. ASPE calls it future taxes, future tax expense. All right, so under asset and liability approach for number 2, we do have to record the deferred taxes. So that's where this video comes in. So when you're trying to calculate the deferred taxes, or why you calculate deferred taxes, is because what you're doing today in this year, so what you're doing in this fiscal year for your company, is going to have an impact on your taxes in future years. So therefore, we have to set up either a deferred tax asset or a deferred tax liability for any taxes you will pay in the future or any tax savings you will have in the future. So whatever you're doing now might lead to tax savings in the future, in which case you would set up a deferred tax asset now, or what you're doing now may lead to paying more taxes in the future, and therefore you would have to set up a deferred tax liability for your future taxes you have to pay. So that's what deferred income tax is all about. So what we're going to do is compare what was deducted for and added for tax purposes versus accounting purposes. This deferred tax only deals with temporary differences. So that's why it's really important to make sure you know the difference between permanent differences and taxable differences, because step number 2 only deals with temporary differences. So you have to take all the temporary differences that you adjusted for in step number 1 to determine what your deferred tax will be. There's 2 types of temporary differences. There is taxable temporary differences, which is added to accounting income. And then there's deductible temporary differences, which is deducted from accounting income. So remember, we added a bunch of like items to accounting income to get taxable income, and we deducted a bunch of numbers to get taxable income. So they're just called taxable temporary differences or deductible temporary differences. So in order to determine our deferred income tax and whether it's an asset liability, we're going to use a deferred income tax schedule, which I'll show you in a bit. But let me just explain this a little bit further of why we record deferred income tax. Okay. So I have an example here where company A purchased an asset for $1,000. The equipment has a useful life of 5 years and no residual value. So $1,000 asset has a useful life of 5 years. So under accounting depreciation, your accounting depreciation, $1,000 divided by 5 years is going to be $200 per year, right? And then at the end of 5 years, you're going to have deducted the full $1,000. For tax purposes, you don't use depreciation, as we know. You use capital cost allowance, CCA. So I've just made up these numbers here. I didn't use a certain percentage, but for example, for the first year, you can take 300, second year 250, 200, 150, 100. It's a declining balance because you're using a percentage, right? So it's declining, but I've made these numbers up so they don't fit a percentage. But because for capital cost allowance, if you have taken your tax courses yet, capital cost allowance, you were allowed to deduct anything from $0 to whatever the maximum percentage is. So you can decide in a year where there's a loss, the company can decide we don't want to take any CCA this year because we have a loss already. So we can take 0 CCA this year and save that deduction for a future year where there is income. Okay, so just keep in mind that for CCA, you're allowed to take anything between 0 and whatever the maximum percentage allowed is. For depreciation, we would have to take, if we're doing straight line, we have to take the same amount every year. I mean, we always have to take depreciation. We can't skip a year. But for tax purposes, we can. We can take an amount of 0. Right? But then at the end, you would have taken the full $1,000. So this, we're going to have a temporary difference in year 1, year 2, year 3, year 4, year 5, because, well, maybe not year 3, but like if you see there's differences between tax and accounting, right? We're taking a different thing between tax and accounting, but at the end of 5 years, we've taken $1,000 for both accounting purposes and tax purposes. So this is why this is a temporary difference, because throughout the years you have a difference, but at the end of the 5 years, you don't have a difference anymore between how much deduction you've taken from tax and how much deduction you've taken from accounting, because they both, you would have fully deducted those. So the first year, so let's look at the first year. We took accounting depreciation of $200. We took a CCA of $300. So we've taken more of a deduction for tax purposes than we have for accounting purposes. So because we've taken more of a deduction for tax purposes, this year, we have less of a deduction to take in previous years. Sorry, in future years. So because remember, we're allowed to take anywhere from 0 to the maximum amount. So if we took a deduction of 0 here for the first year, then we would have $300 to use up in the next years. But this first year, we took a $300 deduction for tax purposes. Because we took such a large deduction for tax purposes, more than the accounting depreciation, in the future, we won't have as much of a deduction to take. So then if we're taking more of a deduction now, let me just bring my pen. So if we're taking more of a deduction now, that's because we took 300 instead of taking like a 200 amount, right? So So if we took 300 for tax. So we took more now, right? More deduction. So we took more of a deduction now, which means if we took more of a deduction now, would we pay more tax now or less tax now? If we took more of a deduction now, that's going to decrease our taxable income, right? And if our taxable income goes down, what happens to how much tax we have to pay? The amount of tax we have to pay also goes down. So we're paying less tax, right? So that's this year. So year one, we're paying less tax because we took a large deduction for tax purposes versus accounting purposes. But in the future years, because we took such a large deduction, we took $300 this year. In future years, we're going to have less of a deduction available, right? Because we've taken a big deduction first year. We could have taken 0 first year, which would have led to more deduction. In future years, less deduction, which means higher taxable income, which means more tax in the future. So if we're paying more tax in the future, when we're thinking about setting up a deferred tax, do we set up a deferred tax asset or do we set up a deferred tax liability? If in the future we're paying more tax, then we have to set up a liability. Okay? So what we do today is going to affect what happens in the future. So because we're taking more of a deduction today for tax purposes, and you can compare it to accounting, that means we're not going to have as big of a deduction in future years, which means more taxable income, which means more tax we have to pay in future years. So if you want to look at this in a different way to understand better, you can look at accounting. How much have you taken for accounting versus how much you've taken for tax? You can say you're cheating here. So you're cheating because you're taking more of a deduction for tax purposes than you are for accounting purposes. Okay, so you can look at it like that as well. So in this case, we would have to set up a liability for how much tax we'll have to pay in the future. So that's what deferred tax is all about. If we decided to take, let's say, $50 deduction, if we decided to take a $50 deduction instead in year one, then we're paying more tax in year one, right? So we're paying more tax in year one because we took a little bit of a deduction, but then we have $250 worth of deduction we can add to the future years. So in the future, we'll be paying less tax, and therefore you would set up a deferred tax asset. Okay, so if you have to pay more tax in the future, you set up a liability, deferred tax liability. If you pay less tax in the future, you set up a deferred tax asset. Okay. What's nice is that we have this deferred tax schedule to do most of the work for us, so we don't really have to do the thinking that I was just showing you. So this deferred tax schedule kind of does everything for us, right? And this is a schedule that we would use to figure out what our deferred tax asset or liability is at the end of the year. So here we're going to start with what is our balance sheet account we're working with. We're going to look at the tax basis. We're going to look at what's the accounting carrying amount, whether it's a taxable or deductible temporary difference. So taxable is going to be in brackets. What the tax rate is, and what our deferred tax asset or liability we have to record is. Okay. So looking back at the example for PP&E, for the depreciation versus CCA, what we have to look at is one thing we have to look at is, well, what's the accounting carrying amount? What's the amount on the balance sheet for this temporary difference? Okay, so we know that we took a deduction of $200 for accounting purposes and a deduction of $300 for tax purposes. So what is the carrying amount at the end of the year? So what is the net book value? It's called net book value for accounting purposes. For tax purposes, it's called UCC, or undepreciated capital cost. Okay, so let's take a look at that. So if we look at what is the opening, okay, so we have to figure out what our ending carrying amount is, or what our ending net book value is. Okay? To do that, we start with our opening. So we're opening net book value, or opening UCC for tax purposes. So it's called UCC. We're going to figure that out, and then we're going to figure out what our depreciation or what our CCA was for the year, and then we'll see our ending. And then we'll get to our ending net book value or ending UCC. So UCC and net book value are the same thing, just tax terminology uses undepreciated capital cost, and accounting uses net book value. Okay, so it's just basically what is the value, was the ending amount of your asset after depreciation and CCA has been taken out. So then we have accounting purposes and we have tax. So our opening net book value in UCC, we bought the asset for $1,000. If you look at the previous slide. So we bought the asset for $1,000. We took depreciation in the first year. We took depreciation of $200 and CCA of $300. So therefore, our ending net book value is $800 for accounting, and our ending UCC is $700 for tax. Okay, so we need these numbers because that's going to develop what our tax basis and accounting carrying amount is. Okay, so the difference between this depreciation and CCA, that's going to fall under our PPE account. Okay, so we have our PPE account, that's our statement of financial position account. Tax basis, we're going to take, so let me just write this on here instead. Okay, so we have PPE. Our tax basis, we're bringing this 700 down. So our tax basis is 700. That's our ending UCC. Our accounting carrying amount is 800. So that's our net book value. Okay. So we've done that. That's how you fill in that part of the schedule. To get your taxable or deductible temporary difference, you basically take your tax basis minus your carrying amount. Okay. So tax basis minus your carrying amount. So tax basis minus your carrying amount is going to equal your temporary difference. We have to make sure that we follow the signs. So whether it's a positive or negative, that's very important because when we try to figure out whether this is an asset or a liability, a positive amount will be an asset, a negative amount will be a liability. Okay, so 700 minus 800 is going to give you negative 100. So that's your temporary difference here. Then we're gonna multiply this by the tax rate. Our tax rate, we'll say, is 30%. Okay. So we multiply this by our tax rate, and 100 times 30%. Make sure you follow, if it's brackets, keep the brackets. So that's gonna give us $30. Okay. Because it's in brackets, it's a liability. So you can see here, the brackets is a liability. If this was a positive amount, it would be an asset. So why is it a liability? Because we've already figured out here that because we're taking more of a deduction for tax, we're cheating. So we only took 200 for accounting, we took more for tax. Because we took more of a deduction for tax this year, that's going to lead to paying less tax this year, but lead to paying more tax in the future because we don't have that deduction available for us. And that's why it's a liability. So we're going to set up a deferred tax liability. We're going to debit deferred tax expense, credit deferred tax liability. Well, I'll show you the journal entries in another slide. Okay. So then we have the answer there. So this schedule works really good for PP&E because we have tax basis, which is our UCC, we have a carrying amount, which is our net book value, and then we can subtract the two to get our temporary difference. We need to do this for all our temporary differences. So this is great for PP&E temporary differences. It's not so great for the other temporary differences that we have. So if we have cash received before earning revenue, cash received after earning revenue, if we have any accruals, those are all temporary differences. Okay? So we because we don't have like a UCC for that kind of stuff, the rest of our schedule, when we do our other temporary differences, your tax basis is going to be a 0. Okay, so we'll walk through the AR example and then I'll show you. So let's do an example with AR. So let's assume that AR, so AR means that you've done the work but haven't received the cash yet. Okay, so let's look at the journal entry. So if we've done the work but haven't received the cash yet, we're going to debit AR and credit revenue. So let's do 500 there. So we know that this is going to go into revenue. We know it can't go into taxable income yet because we haven't received the cash. Maybe next year we'll receive the cash and record it there. So we've done step number 1, where we've taken this out, so deducted it in order to get taxable income. For the deferred tax schedule, what we have to do is put all the temporary differences here. So our balance sheet amount is your AR, right? So revenue goes into income statement. So you're taking out whatever the balance sheet amount is. Your tax basis is going to be 0 because there is no UCC or anything like that. Your tax basis is always going to be 0 for anything other than PP&E in order to have the schedule work out for us. Okay? Your carrying amount, so for accounting, your carrying amount is 500 because that's how much you have for this temporary difference on your balance sheet. Okay, so your carrying amount is 500. If we take 0 minus 500, we're going to get negative 500. Okay, make sure you follow these. Multiply it by the tax rate, 30%, and we're going to get negative 150. Okay. So multiply by tax rate equals negative 150. Okay, so what's the reason why this is a negative, which means this is going to end up being a liability. So what is the reason why this is a liability? Well, it's because you're recording this $500 in revenue today or this year. You're not recording this for taxable income, but the next year when you get paid the $500, you actually get the money. Then you're going to record this under taxable income. It's going to increase your taxable income. If your taxable income goes up, that means the amount of tax you have to pay is going to increase. So we know in the future that we're going to have to record $500 of revenue for tax purposes because we know this money is going to come. Once the money comes, you're going to increase your taxable income, which is going to increase the amount of tax you have to pay. So we know in the future, we have to pay this tax. Okay. And that's why this is a liability. But you don't really have to do the thinking because this schedule does the thinking for you because you just take this tax basis minus accounting basis and it gives you a negative. Okay, but I just want to show you the logic there. Okay, so let's look at another example. Let's look at unearned revenue. Okay, so this is cash received before earning the revenue. So cash received before earning the revenue. We receive the cash, so we debit cash and we credit unearned revenue. So we received $200 of cash. We recorded an unearned revenue because we haven't done the work yet. This is a temporary difference. It's going to go into step number 1 to determine taxable income. We're going to have to add this $200 to our accounting income to get taxable income. Okay. So the statement of financial position, you're always going to include the account that's not cash. Okay, so we're not going to use cash here. We're going to use unearned revenue. So if you have cash and something else, use the something else. Okay, so right now, unearned revenue is going to be our statement of financial position. Tax basis is always going to be 0 for anything other than PP&E. Our carrying amount here, unearned revenue is showing at $200. Okay, so 200. Tax basis minus accounting basis is going to equal, sorry, this is a liability, right? Unearned revenue is a liability, so we have to make it a negative. Anything that's an asset is positive, so AR is an asset, so that's positive. Anything that's a liability is negative. Okay, so make sure you make this negative. So 0 minus negative 200 is going to give you positive 200. Times your tax rate, 30%. That's going to give you a positive 60, sorry. So that's going to be an asset because it's a positive amount. That's an asset on your book. The reason why when you do unearned revenue, it results in an asset, is because you already would have paid, or you're already going to pay the tax for this revenue. So because cash was recorded, that means for tax purposes, you are going to include this for taxable income in this year, which means next year and the following years, you'll pay less tax because you've already included this for the current tax year. So that's why this is an asset there. Another example we can look at is warranty. So we'll go to the warranty liabilities. So when we're looking at warranty liabilities, at year end, you have to estimate how much warranty you're going to use up and record a liability for that. So the journal entry for that is warranty expense debit. So warranty expense is going to be debit, and you're going to credit warranty liability. And let's say that one is, what do we say here? So $300, right? So 300 and 300. Okay. So when you go over to, because this is a temporary difference, because you're recording the estimate of the warranty expenses for accounting purposes, but you're not allowed to record this in for tax until the warranty has been paid, or the costs have been incurred for this warranty. So here we're only bringing in the statement of financial position amount or number. So that is your warranty liability, because warranty expense is on the income statement. So warranty liability. Your tax basis is 0 for anything other than PP&E. And because it's a liability, it's going to be a negative. So negative 300. So the tax basis minus accounting basis equals positive 300. These two negatives cancel each other out, and it's positive. Then we're going to use a 30%. 30% times 300 gives you positive 90. All right, so those are 4 examples of how to complete the deferred tax schedule. So then you don't have to do a separate asset and liability for each one of these. You can add it up to find out what your ending deferred tax asset or liability is. So if we have all 4 of our examples, we have 2 liabilities, 2 assets. If we total everything up, we have a negative amount of $30, which is a liability of $30. So what we're going to do is we're going to set up a deferred tax asset for $30. Okay, so let me show you the journal entries here. So if it was an asset, we would, if there's a positive number on our schedule, that would mean it's an asset, and we would debit deferred tax asset and credit deferred tax expense. Well, let me just explain to you why this warranty liability is a positive amount, why this would be an asset. That's because, so let me just go back one more so we can see the journal entry. So here we're recording an expense of $300 for accounting purposes, but we're not deducting anything for tax purposes. So we know that in the future, this deduction will be available. All right, so if it's an asset, debit deferred tax asset, credit deferred tax benefit. If it's a liability, debit deferred tax expense, credit deferred tax liability. So this deferred tax expense / benefit is like an interchangeable account. It is a deferred tax expense, but if it's going to be a credit amount, then it's going to be a deferred tax benefit. Right? So we'll do exercise 2, part C in our Excel. Before we do that, I'm just going to show you the financial statements again for the entire, so deferred tax expense / benefit. So here, if it's a debit amount, it's an expense. If it's a credit amount, it's a benefit. Okay, so that's how that is showing there. Okay, so let's go into our Excel. So if you go back to the Excel, chapter 18, step 1 and step 2, question 2, we did part of this question in the previous video for step number 1. We're going to complete it now. So part D asks us to, part C asks us to calculate any deferred tax balances at December 31st, 2014. So what we want to do is look back at this example and go to our temporary differences, and we notice that we did have a temporary difference for depreciation CCA and for unearned rent revenue. Okay, so depreciation CCA, that's going to be your property, plant, and equipment, or your capital asset. So if we look at that, we have to figure out what our UCC is and what our carrying amount is. Okay. So if we go back up to the question, it says that property plant was purchased in the beginning of the year, beginning of 2014, for $300,000. Okay, so we know that this is the first year of operations as well. So we know that this asset hasn't been depreciated yet. Depreciation of 40 was taken and CCA of 56. So we know our opening, I'll just do a quick chart here. So our opening net book value, or UCC, is 300. So if we do it for accounting and do it for tax, just to find out what our ending one is, so we know what our tax basis and accounting basis is. So 300, 300,000, and 300,000. And then our depreciation, or our CCA. So it says depreciation of 40,000 was taken, CCA of 56,000 was taken. And then we have our ending net book value, or UCC. Yeah, so 300,000 minus the 40 and 300,000 minus the 56. Okay, so our ending net book value for accounting purposes is 260. So we can bring that down to our spreadsheet here. So that's 260. The 244 comes from the ending balance for the UCC for tax purposes. So 244, so that's here. And then if we take 244 minus 260, that gives us a negative 1,600. Okay, so just tax basis minus carrying amount gives us negative 16,000 times by the tax rate. So in this question, it told us that Melissa's tax rate is 30%. Times by the tax rate, and then you get negative 4,800. So that's a liability. It's a liability because we're taking more of a deduction for CCA than we are for accounting, which means we'll have less of a deduction in the future and have to pay more tax in the future. Okay. The second temporary difference is rent revenue reported in the tax return is $24,000 higher than rent revenue reported in the income statement. Okay, so we have some rent revenue received in advance of actually doing the work. So the journal entry for this would be cash, 24,000, debit, credit, unearned revenue. Okay, so unearned revenue we have here. Tax basis is always 0 for anything other than the capital asset. Yeah, so it's always going to be 0. Carrying amount is whatever the accounting carrying amount is. So on the balance sheet, so we have cash, debit, credit, unearned revenue. So you don't use the cash account, use the other account that shows up in the statement of financial position. So that's your 24,000 unearned revenue. And unearned revenue is a liability, so it's a negative on your schedule. 0 minus negative 24,000 gives you positive 24,000. Times by the tax rate gives you an asset of $7,200. Okay. So add these two up together, that will give you a total asset of $2,400. Okay. So that's how much your deferred tax asset or liability balance needs to be. And because it's a positive amount, it's going to be an asset. The next step that you have to do is check what the deferred tax asset or liability balance is at the beginning of the year. Okay, so this is what it needs to be. This 2,400 is what it needs to be at the end of the year. So this is your end of the year balance. We need to compare it to what the balance is right now in order to determine what we have to record as an asset or liability. So if you go back to the question, here it says the opening balance of any deferred tax asset or deferred tax liability is 0. Okay, so because this is the first year of operations, we already know that there is no balances anywhere, so that's 0 there. And then we know that the adjustment we have to make, the journal entry, is 2,400. So we're going to debit our deferred tax asset, 2,400, and we're going to credit our deferred tax expense / benefit, 2,400. Okay, so then the last thing to do is just make sure you do the journal entry for deferred tax. The last thing I want to show you is your income statement presentation. So just to show you what this is going to look like on the income statement, you have your revenue, you have your expenses that you deduct, you get your net income before taxes. Remember, we had stopped at this point up until chapter 17. And then we have our income tax expense. So we have our current tax expense, we'll have our deferred tax expense or benefit, and then add that all up, and that's, or sorry, net income before tax, you're going to subtract your expense, add your benefit, and then you get net income after tax. Okay, so that's just the income statement presentation, just to close off that the question. So the last thing there is, what is the income statement presentation? So income before taxes was 105,000, shows up in the first sentence there. And then you just kind of take a look at what are the journal entries that hit current tax expense and deferred tax expense. Right? So here, current tax expense, 35,400. Okay, so you bring that over, 35,400. And then we had a deferred tax benefit of 2,400. So that was a credit amount. So if you subtotal these, that gives you 33,000 as your expense. 105 minus 33,000 gives you 72,000 as your net income after tax. Okay, so just closing it off with just a quick income statement presentation here. All right, let's move on to question number 3. Like I said previously, make sure you pause this video, attempt this question yourself, and then you can resume this video again after you've done it to check your answers to see if you were at the answer or close to the answer. So let's do the take up now. Jenny Corporation recorded warranty accruals at December 31st, 2014 of $150,000. This reversing difference will cause deductible amounts of the following. So 50,000 in 2015, 35,000 in 2016, 65,000 in 2017. So what this means is, so Jenny Corporation recorded a warranty accrual of 150,000, and then we have some knowledge of when the actual amount is going to be paid. So they're going to actually pay $50,000 for this to service this warranty in 2015, 35,000 in 2016, 65,000 in 2017. So 2015, 16, 17, this is when it can be recorded for tax purposes because that's when the cash was going to be paid. The accrual was just done in 2014. So if you add up the three amounts, 2015, 16, 17, we'll get 150,000. So the full accrual was used up in the 3 years. Jenny's accounting income for 2014, it should say. Accounting income for 2014 is 135,000, and the tax rate for all the years is 25%. There is a deferred tax asset at the beginning of the year for $800. So the first requirement is to calculate the deferred tax balance at December 31st, 2014. So we only have the one difference here, which is the warranty accruals. We don't have any other temporary differences. We don't have any permanent differences. This is a temporary difference because for accounting purposes, an accrual was recorded of 150,000 in 2014, but you're not allowed to record this for tax purposes until the cash has been paid, and the cash was paid from 2015 to 2017. So there is a timing difference of when this can be recorded for tax purposes and accounting purposes, and that is why there is it's a temporary difference, not a permanent difference. Okay. So before we do our schedule, let's think about what would have been the journal entry that Jenny Corporation did to record this warranty accrual. So what they would have done is they would have debited, let's use a more friendly color here. They would have debited warranty expense and credited warranty liability. or $150,000 at December 31st, 2014. Okay, so that's what they would have done. So when we're putting this over into our deferred tax schedule, we're going to take the statement of financial position balance, which is a warranty liability of $150,000. Again, your tax basis is always zero for anything other than PP&E. The carrying amount, because it's a liability, it's going to be negative. Okay, so it's just our liability balance, but it's a negative amount. So that's moved over here. 0 minus negative 150 gives you positive 150. Okay, so tax basis minus accounting basis, our carrying amount gives you your temporary difference. Multiply it by the tax rate. We were told that the tax rate is 25%. If you multiply 150 by the tax rate, you get 37,500. We don't have any other temporary differences to put in our schedule, so the deferred tax liability we need at the end of the year is 37,500. So that's what the balance should be at the end of the year. We need to compare this to what the balance is currently or at the beginning of the year. So what's the opening balance of our deferred tax asset? And just to note again, the reason why this is an asset is because for tax purposes, we're not recording this deduction of 150,000, but we know in the future we will be able to record these 3 deductions, and therefore we will reduce our taxable income in the future and then reduce the taxes we have to pay. So that's why it's an asset, because we're going to save tax in the future. So you need to compare, so 37,500 is what the ending balance of a deferred tax asset should be. We need to compare this to what the opening balance is. So it tells us here that there is a deferred tax asset at the beginning of the year of 800,000. We want the ending balance of our deferred tax asset to be 37,500. If the opening balance is 800, what is the journal entry that we'll need to do to get that balance to 35,500? So let me just do a quick T account so we can determine what we need to do here. So if this was our deferred tax asset, DTA, we have an opening balance of $800. We need an ending balance from what our schedule tells us of 37,500. So what do we have to debit in order to get there? So if you just take the 37,500 minus the 800, you'll get 36,700. So that's the adjustment we need to make. That's a journal entry that we need to do to defer tax asset. So if you look at part B, sorry, I think part C asks us to record the journal entries. So I'll just show you this journal entry since we were doing that step anyways. So the deferred tax asset gets debited 36,700. Deferred tax expense / benefit. So in this case, it would be a benefit because it's a credit amount, 36,700. All right, so let's do part B now. Calculate the income, the taxable income and current tax payable for 2014. So this is step number 1, which you would have learned in the previous video. You're going to start with accounting income, which is 135. So it told us here that accounting income for 2014 is 135. You're going to adjust for permanent differences. There aren't any in this question. You're going to adjust for temporary differences. There is warranty expense. That's the only temporary difference we have here. There was an accrual made for warranty expense of $150,000. This is not allowed to be deducted for tax purposes. So it was already deducted to get the net income amount for accounting purposes. So in order to get the taxable income, we have to add it back. So we're adding that back to get a taxable income of 285, multiply it by the current tax rate, which we know has told us, the question has told us is 25%. And we get 71,250. So after you figure out what the income tax or current tax expense is, then we can do our journal entry, debit current tax expense, 71,250, credit income tax payable, 71,250. So that was the last video, step number 1 for chapter 18. And then lastly, part D says to prepare the income tax expense section for 2014. So we're going to start with income before tax, which was 135. And then we're just going to look at what the journal entries we did. So we did a journal entry to current tax expense for $71,250. And we did a deferred tax benefit of $36,700. So an expense is going to bring down net income. A benefit is going to increase net income, right? So we have the current tax expense, the deferred tax benefit. So in total, the expense that's going to bring down our net income is $34,550, and our net income after tax is $100,450. So I hope this video or this example and the examples before this and the video made sense on chapter 18, step 2, deferred income tax expense, and the deferred tax asset and liability. The next video will finish off chapter 18. We're going to do the step number 3, which is accounting for tax losses. Thank you for listening. Take care.